My name is Stephen Reiter. I'm responsible for the options trading platform with AvaTrade. This platform is our own design and our own proprietary interface, so we're very proud of it, and I think you're going to like it. You're going to find it easy to use. And as I mentioned earlier, if you send questions, I'll be able to see them in the chat. So let's start off with just a very simple question. What are options? We really need to define the landscape that we're working with. I'm going to answer this question very quickly, talk about what are options and how to use them very quickly, and jump into the platform, because my assumption is that most of you already have some knowledge about options, and you're here because you're interested in seeing how you can trade them with AvaTrade. On the screen, you've got a picture, a profit and loss diagram for a normal FX trade or a spot trade or a forward trade. On the x-axis, you have the euro-dollar rate, and on the y-axis, you have profit and loss. If you buy euro-dollar and the market goes higher, then you'll have profits, and if the market goes lower, you'll have losses. It's a symmetric payoff diagram. As the market goes up, you profit. As the market goes down, you lose. What's different about options is that we can offer an asymmetric payoff, like this. With an option, in the case of buying a call option, on the upside, if the market moves higher, you participate 1-for-1 with the market. And on the downside, your option can finish out of the money, which means the most you can lose is what you paid for your option. That's the option premium. So options give you asymmetric payoff, whereas spot or a forward gives you symmetric payoff. And that's the real opportunity with options, is that you can tailor your exposure to meet your view. And again, if you have questions, please type them in. If anyone cannot hear me well, if I need to change my microphone or something, also please type into the chat so that I'm aware. Here's an example with numbers. Let's say that the wherever Forex is trading right now, let's say at 115. Let's say euro-dollar in the center of this picture is trading at 115. If the market moves higher to 117, in the spot trade, you're going to make 2 points or 200 pips. And on the downside, you're going to lose 200 pips if it drops to 113. If you buy an option for, let's say, a week, it might cost you 60 pips. So if you buy a call at 115, which means you have the right to buy at 115, it's going to cost you 60 pips. In 1 week, if the market is still trading at 115, your option expires without any value, because you have the right to buy at 115, but you can also buy in the market at 115. And that's why in this P&L diagram, you can see that you're going to lose 60 pips. But you're not going to lose more than 60 pips, even if the market goes lower. And that's really the whole power here, is that even if the market goes lower, we're not going to lose more than what we paid for the option. Whereas the spot trade is going to lose much more. On the upside, however, you're going to participate with the market. You have paid 60 pips, so you're going to underperform compared to the spot trade, but you're participating all the way up. So it's very similar to insurance, where you pay a premium up front, and if you have an accident, if you need the protection, if the market is going in a certain way, you're going to get paid back by the insurance company. So options are very much analogous to insurance, and it's a good way to think about things. Let's kill the pen. Okay. Some definitions. We have two types of options, and we're always dealing, by the way, with vanilla options, regular standard options, which are standard European style calls and puts, which means you have a call that gives you the right to buy a specific instrument on a specific date in a specific amount. A put option gives you the right to sell at a specific price, and you can either buy or sell the options. Premium is what's called the price of the option. Again, in insurance, you also call the price of insurance the premium. Strike is the price of the instrument at which you can buy or sell. And the expiration date is the date and time at which you have the right to exercise that option. Remember, we're doing European style options. They can only be exercised on the expiration date, and they're exercised automatically on the expiration date. Prior to the expiration date, if you want to close your position, you simply sell the option. You close it by, just like you would close any other position, you can sell your option back to the market with our platform. Here's a picture of a put option. A put option is similar to going short the market. Buying a put option gives you profits if the market falls below the strike. Selling a call option is also similar to going short the market in one direction, in that when you sell a call option, you're like the insurance company, you're selling insurance. If the market goes higher, you're going to lose. You're going to lose less, however, than simply going short the market, because you're also earning premium. Right? If you're selling an option, you're getting paid that 60 pips or whatever the price of the option is. So you're getting paid, and that's why if the market falls or if the market stays below your strike, you get to keep all of this premium and have profit in this area. So by selling an option, you're like being in the insurance company. You sold insurance, it was a good trade, the driver that you insured didn't have an accident, or the ship that you insured didn't sink, and you get to keep your premium. Oops, get rid of that. Selling a put option is like going long the market. There are other analogies that I'll give you, but if you go long the market and the market falls, you're going to lose money by being long the market in trading regular FX. You'll also lose money if you sold a put, because again, you're selling insurance. But once again, you're getting paid for selling that option. So this is really where a lot of the power of options trading comes from. It's the ability to sell options, not just buy options. Buying options, you're getting leverage, you're getting directional view. It's a lower risk way to trade. But selling options gives you something really unique, and that is the ability to earn premium. You can combine options in order to do strategies. We'll show some examples in a moment when we jump into the trading platform. Directly to the platform with an account number, or you can log in at directly to the platform, or you can log in at the Ava website with your email and password, and then you click web trading to get into the web trader. Okay, so now we're logged into the platform, and you're going to see that it looks like other trading platforms. On the left side, we've got bid and ask for the various assets that you can trade. And this is not just options, these are the spot trades or the underlying assets. So you can trade Eurodollar, you can trade Kiwi, you can trade gold. Let's look at gold. Gold is now trading at 1670. This is the chart in the center. It's a 1 minute bar. You can change the bar size here. You can look at a 15-minute chart. We can change the type of chart. We can add studies like moving averages. Let's look at an exponential moving average. I'll put the moving average in purple, make the line a little thicker. You can put Fibonacci and whatever here, Bollinger Bands, whatever types of signals you want to add. I'm going to clear those out. Go back to trading. What's unique on our platform? On the right side of the page, you have a profit and loss diagram. I can show it a little bigger. We're looking at buying 100 ounces of gold. You can change the quantity up here. If I buy 100 ounces of gold and the market goes up, I'm going to profit in green. If the market goes down, I'm going to lose in red. If I go short the market, my profits are when the market falls. So let's say I'm interested in going short gold in 100 ounces. You've got your profit and loss diagram. I can also add limit orders. Just like any other trading platform, I can add a take profit. So let's say I want to put in a take profit at 1650. I just double click. I can put in my exact value. I'll put in a take profit at 1650, and 1650 is not on the page. It disappeared. Let's put that again. I think I put 165 instead of 1650. There's my take profit at 1650, and I might want to put in a stop loss. Let's say I'll put it at 1690. And the profit and loss diagram shows you that if we hit the take profit, if I go short right now, hit the take profit, I'm going to profit $2,070. If we hit the stop loss instead, we're going to lose $1,940. So you can see visually, very easily, by just moving the take profit and stop loss up and down, what risk you're taking. I'm going to execute this trade. It shows me how much margin I need, how much margin is available, the cost of the trade, which is the daily interest cost. And if you're an Islamic, if you need an Islamic account, an interest-free account, just ask your account representative for that. The bid-ask spread it shows is $29. I click execute and it's done. And now you'll see it in the bottom of the screen in our open positions. We sold gold at 1670 and we have a stop at 1690 and a limit at 1650. Very simple, easy to use. That's just trading spot. But we're not here to trade just FX, we're also looking at options. So if I click the strategy button here where it says spot, I can now choose option strategies. Option strategies are really where all the power comes from options. We can trade simple options like a call. Let's look at buying a call. I'm going to close the limit panel. Buying a call, if the market moves higher, I have unlimited profit potential. If the market goes lower, the most I can lose is what I paid for the option. So what we've done here is we've taken that P&L diagram that we started with in the PowerPoint presentation, we've turned it on its side. So you can see the most we can lose is what we paid, and our profit potential is unlimited. This is a 1-week option. Here I can choose my expiration date. We can make it a 1-month option. We can choose any day we want. I'm going to choose a 1-month option. When I do that, it shows us automatically 1 month of history. Where has the market been? In the center, it's showing us a confidence range. The confidence range is telling us where we think the market may go in the next month based on the implied volatility of the option. Gold is trading at an implied volatility of 16%. Using the implied volatility of 16%, we can calculate standard deviations. So the volatility times the square root of time times the asset price is the value of one standard deviation. And basically this gray zone in the center of this confidence range is plus and minus 1 standard deviation. We can say that we are 67% confident. I think it's 67, it might be 65. 67, let's see, we got it here. Here we go. We are 68% confident that the market is going to be within plus and minus 1 standard deviation, and we're 95% confident that it's going to be within 2 standard deviations. So in the light gray in the center, that's plus and minus 1 standard deviation, and in the white line with these 2 white dots, that's 2 standard deviations. So we can say we're 95% confident the market is going to be between, looks like about 1830 and 1520. It's a fairly wide range, but that's what the volatility is telling us. So we're trying to frame the risk of the trade. As we change the strike of the call option, you can see the price of the option changes. So here's an at-the-money option. We're trading at 1670 and we're buying a call. The right to buy at 1670 is going to cost $34 per ounce. You can see the total cost for 100 ounces, or we can see the price in per unit. So $34 is the price of a 1-month option at the money. If I want to buy an out of the money option, if I have the right to buy at 1750, it's going to be significantly cheaper, right? Because the market has to move higher in order to reach that strike and to begin to profit. If you look at the red and the green in this diagram, you can see that they kind of offset each other. It's risk versus reward. Buying a further out of the money option is cheaper because the chance of profit is smaller. Buying an option that's in the money, if I have the right to buy at 1550, Well, we're already trading at 1670. It's way in the money, so it's very expensive. But the profits and loss areas offset each other again. The orange line in the middle of the red and green is showing us the P&L today. So we can see right now, if I buy this option and sell it, I'm going to lose a little bit of money. That's the bid-ask spread. But as time goes by, if the market doesn't move, I'm going to lose the entire cost of the option, which is $35. We can see how this orange line, how the horizon line changes over time by dragging our horizon line in the center over. Today, now, the orange line shows that you lose the P&L, you'll only lose the bid-ask spread. But as time goes by, that orange line approaches the red and green, it approaches expiration. Let's look at selling an option. It looks like this. Selling an option, if I sell a call, if the market does not go higher, I'm going to keep that option premium. I'm going to earn $3,200. If the market moves higher, I'm going to start to lose money once we hit the break even. The break even would be $3,200 in the money, or $32 per ounce. So if we're trading today, if the strike is 1670, my break even is going to be at 1702. You can see that pretty easily. If I want to do this trade, I just click sell. Because I'm selling an option, it requires margin. It tells me how much margin I need. Execute, done. There it is in our open positions. It showed up right away. We are short an option at 1670. We have lots of option strategies to offer. Calls, puts, straddles, strangles, risk reversals. If you want to know what they are, click on the guide. The guide turns this into a little dictionary of options, or an encyclopedia of options. Here's a call. Here's buying a call, buying a put, a call spread. You're buying one call, selling another call. Ratios, straddles. A straddle is buying both a call and a put at the same strike. You think that's interesting? Click try it, and it shows you. We're buying a call and a put at the same strike. This is gold, so it's expensive. And you're only going to profit after the market moves a long way because you paid for two options, but in the end, only one of them is going to finish in the money. Straddles are popular for selling strategies because, again, you're selling two options, but your break-evens are quite large because you're earning premium from two options. Similar to a straddle is a strangle. In a strangle, you have different strikes for the call and the put, and you can control them separately. So I can look at the historical chart. We've got 1 month of history, and I might say, well, the market didn't get much above 1720, so I'm going to put my call strike at 1720, and I'm going to put my put strike down at this support level, looks like around 1620. So I'm selling a 1620, 1720, 1 month strangle. I'm going to get paid almost $23 per ounce for that. So my break-evens are going to be $23 on either side of the strikes. So my range is going to be roughly from 1600 to 1740. So it's a $140 range for a month. And you can see for the past month, we've stayed within that range. I can change the chart. Instead of looking at an 8-hour chart, let's look at a daily chart. And you can see going further back how much risk you've got, or where the market has been for the last, this is going back to June, so roughly the last 5 months. You can basically chart anything you like. And again, if you like the trade, you click sell, execute, it's done, and it shows up in our open positions as individual legs. So now you've sold a put and sold a call, and before that we sold a call. Again, we have other assets to trade, of course. You can trade assets that don't have options, like crude. You can trade all the currencies. We've got emerging markets currencies, and it's very simple to use. Let's look at other parts of the platform. The risk manager. The risk manager is taking all of our positions and breaking them down into their parts. So I've got, if you look at our open positions, I've got a whole bunch of open positions here. Let's see if I've got all of them showing. Nope, there's even more. I'm going to pop this out. This button here pops out a window. And unless we're being blocked, everything will show up here. It looks like, there we go. So we've got all of our open positions in a window that you could move to another screen if you had, if you have a workstation with multiple screens. So here's all of our positions. And you can see we've got positions in gold, we've got positions in sterling against the dollar, euro dollar, dollar CAD, dollar Swiss. We can sort, we can filter. Here I'm sorting by the asset. We also can sort by the expiration date, by the order number. You can filter and just look at our euro sterling positions, for example. We've got every which way a complete platform here. The risk manager is taking those positions and breaking them down. So let's look at the table. The table says we've got 6 positions in gold. We're short 100 ounces of gold, and we're short another 60 ounces through options trades. So we take the delta of all of our options trades and we add them up. Net, we're short 160 ounces of gold. In the pound, we only have options positions. In euro sterling, we only have options positions. But if we break down euro sterling, it says we're short euro sterling. That means we're short euros and we're long sterling. We're also long sterling from the cable, from pound against the dollar. So if we are long around 11,000 euros worth of sterling, and we're long another 4,000 from the open positions, we've got about 15,000. It looks like we're long about 15,000 of the pound. And you can see that in the bar chart above. The bar chart's kind of dominated right now by gold because our gold position is bigger. But you can see our net position in sterling, our net position in euros, our net position in Swiss. It's all sorted by size. We've just executed a bunch of trades in the gold. If I click gold, all of our gold positions will show up in our trading window. I'm just going to show you here. Let's close that. These are all the positions that we have in gold right now. We've got calls and puts here at 1670, one's on top of the other. We've got a call above, a put below, and we're short in spot, in cash, we're short as well. All those positions together look like the red and green that you see on the right. And as we move through time, you can see the kinks, and you can see where the strikes are, and you can see how the position changes over time. We can do the same thing with the pound against the dollar. Our open positions in the pound against the dollar look like this. Let's look at them. We're long a call and we're short a call. We're long a call at 114. We're short a call at 116.50. They're expiring in a few days. And here they are on the chart. So you can see where we've been in the pound against the dollar. These are our positions. It's a call spread. And over time, our positions will approach the red and green. If I want to close this position, they're here ready to execute. Click execute, and they're both closed, and they will both disappear from our open positions. This is a pending order, which we did not close. We can do that as well. Close a pending order, closed. Now we have no positions left in the pound against the dollar. You can see our total exposure, the bar charts by currency. You can also see delta by currency pair. So net we're short gold, we're long dollar Swiss, we're long Kiwi. Again, breaking it down by currency instead of by currency pair. That's the difference between these two bar charts. You can also see your exposure to volatility. Vega is showing us how much we're going to make or lose as implied volatility changes. So if we are short options, if implied volatility rises, we're going to lose money, and that's what this is showing. Our Vega, we're short $500 of Vega in gold. So if implied volatility goes from, let's say, 16 to 17, we're going to get hurt in gold if on a mark-to-market basis. Here's all of our gold positions. We showed that before. Let's close some of our gold positions. Let's go over here to our open positions. Get rid of the filter. Actually, let's just filter for gold. Here are our gold positions. Let's close off some of them. Keep our cash. Let's close half of this call. I'm going to do a partial close of this option. Right now we're short 100 of this option. I click execute. Now we're only going to be short 50. And you can see how that's reflected in our risk. Let's go back again here to the risk manager, and I'll click on gold. And you can see what our gold position looks like now. We're short fewer of these puts down below. So what are the different strategies? Calls, puts, straddle, strangles, butterflies, lots of different trades. Iron Condor has 4 trades. Selling a strangle, buying a strangle, or the other way. This is an Iron Condor, some people call it reverse Iron Condor. Iron Condor, butterfly, lots of different strategies. Now let's talk about time. This is a 1-week option on the Australian dollar. The 1-week option at the money costs 61 pips, or $600 for an option on 100,000. If we change the expiration date and make it longer, the cost of that option goes up. And you see it as I move to the right, out to a year, it's going to cost us more than 3 points. Why? Because over a year, we can expect the market to have a much wider range than over a day. And that's why you see that confidence range shows it to you as you move the expiration date to the right and to the left to give you an idea of what the range of the market might be, and then it adjusts when you set your price, when you set your date. So you can choose any expiration date from a day to a year. You can choose any strike just by dragging the strike button up and down. You can even, when you do that, it goes at specific intervals, like here it's going every 50 pips. But if I double click, I can choose any strike. I can choose the at the money forward, the delta neutral strike, which we don't need to get into. But if I want to do an option at 0.6505, no problem. It's priced. I'll do the option on 30,000, execute. And that's done. And here it comes there. It's in our open positions, 0.6505. So we've spoken about time. We've spoken about setting the strikes. Let's look at some other tools we have here. We have AutoChartist. AutoChartist is an automated chart pattern recognition system. I'm looking, let's say, at a spot trade. Let's choose Eurodollar. This number 5 in a circle says that there are 5 recent signals that are automatically derived from the charts that are giving us ideas, technical indicators, according to various bar sizes. So we've got a whole bunch of daily signals. We have a channel up signal on the daily chart. I click that. It says, looking at a daily chart, there's a channel. The market's been moving steadily higher within that channel for Eurodollar over on the daily chart, but it saw a breakout. Let's look at the pattern here. If I click apply, it'll put it right into our chart. It sees this, and it saw this vertical blue line. It saw on the 4th of November, just a few days ago, that Eurodollar looked like it was about to break out of this channel and head lower. So it recognized a bearish signal. It was wrong. You can see that we continue to show the results of that idea. We actually bounced back into the channel. Let's look at gold. It might show something very similar. There is a resistance line that's been identified. That resistance line is at 1675, it looks like. And so it's recommending to buy. Let's look at dollar yen. Dollar yen, we've got a bunch of signals, all channel downs. Channel down on the hourly chart, looks like that. It's recommending to go short the market because we're going to stay in the channel. It was heading towards the edge of the channel. It thought we're going to bounce back in. In fact, the signal was correct. And it recommended putting on this trade with a stop loss at 146.93. So as you can cycle through the different patterns, the different signals, and you can apply them as you wish, and you can modify them. Of course, use them however you want. Here's dollar CAD, descending triangle. It saw a breakout to the bottom of the triangle and recommended going short the market, and it was again correct. The market was trading at 136. We're actually a whole point lower now into the triangle. With a take profit and a stop loss, if you agree with the trade, you set your limit, set your amount, click sell, and it gets executed with all the parts. Dollar CAD with a stop and a limit. You can cancel any piece of that. It can cancel one of the limit orders just like that. Remember, we've got history here, closed trades. We can see the trades that we've closed today, the history. You can look at your history today for the last 2 days, month, whatever you want to see, all available here in the web trader. And I should mention, our web trader has a similar mobile app. Our mobile app and our web trader are identical. They have all the same, almost all the same features. What's going on here? They have almost all the same features, and we really recommend you use them both. Somebody says hide my toolbar. Okay. Bookmarks.
No, you didn't.
Yeah. Okay, we've got lots of things to trade. It's all very simple. We also have implied volatility charting. So if you really understand implied volatility and you want to buy options, you want to know, are options rich or cheap? We have a few ways of showing that. Let's look at the pound against the dollar. I click the I button, the information button. Over on the right side, we get a chart. And that chart has 3 lines. It's showing us implied volatility charts. The center is showing us at the money options. On the right side, you see implied volatility for call options, out of the money calls, 10 delta calls. And on the left side, out of the money puts. In the case of the pound against the dollar, put options are richer or more expensive than call options because of the trend of the market. People are more concerned, or there's more demand for puts than there is for calls. So you see implied volatilities for puts are higher. The red line shows us where vols were a month ago. The blue line shows you where vols are today, and the green line shows you where vols were a week ago. So a month ago, vols were significantly higher. A month ago, you had lots of stock market movement, you had elections, elections are today. You've got all kinds of things going on, of course, especially in the pound. Let's look at the same thing for euro dollar. Same story, vols were higher a month ago. Here's gold, vols were higher a month ago. We have another way to do charting of implied volatility. In the strategy button, in the strategy panel, we have a button here for implied volatility. When I click that, it gives me a chart of implied volatility going back for a year on gold, because I was looking at gold. I can add here other assets. So for example, I'll add implied volatility for 1 month on Eurodollar. And you can see that gold options are always more expensive than Eurodollar options. Gold is a more volatile asset. I can also add to that the pound. Pound is much higher than Eurodollar volatility. In fact, for a moment, it moved higher even than gold volatility, which is interesting. We can also look at historical volatility. Let's look at where gold volatility has been realized. So looking at where the market has been in the past, I can chart 10 delta put vol, delta neutral vol, risk reversals, realized volatility. Let's kill these other two because they're obstructing my view. So here's a chart showing that implied volatility, 1 month implied volatility, has pretty much always been higher than realized volatility. And that is the natural state of the options market. Usually implied volatility is higher than realized volatility. Because the options seller is offering a service. He's taking risk, and he needs to be compensated for taking risk. The insurance company is a profitable business, generally speaking, unless there's a major hurricane or an earthquake or something else that causes calamitous, unexpected, black swan kind of, or just outlying events. The insurance companies, generally speaking, by diversifying their risk, are profitable businesses. Same thing in currency options and other options markets. There are customers that need to buy options, that need to protect themselves. When you're buying insurance, you're generally paying a little bit of a premium, whereas the options sellers can generally expect a little vig, a little bit of extra profit for selling options. And when those numbers reverse, you want to ask yourself why. Why is implied volatility higher today, which is forward-looking, than it was in realized volatility, which is backwards-looking? So if, for example, you have an election tomorrow that you expect to contribute significantly to volatility, then forward-looking volatility very well may be higher than, or expected to be higher than, realized volatility. If you look at this and you think, and you look at this and you see that right now, let's just look at the last 3 months, the implied volatility looks kind of low relative to realized volatility, right? Normally we expect that green line to be under the blue line. Then this is telling you perhaps that gold vol is cheap and you want to buy it. So all I have to do is click on the gold button here and click trade. Because I'm looking at a delta neutral, if you want to buy volatility, profit from volatility, you don't care about the direction. You just think the market is going to be more volatile, then you would buy a straddle or a strangle, because you're going to profit whether the market moves higher or lower from more volatility. If you like that trade, you click buy, set your amount. Let's see, I'll do it on 10 ounces, execute. And that'll pop into our open positions right there. Any questions? Because I promise we'll keep this under an hour. We've been about 40 minutes. Any questions, feel free to ask away. We also have a Windows-based platform. We don't recommend it because our web trader is so much easier to use. It's very visual, interactive. Lots of things we can trade here. Lots of ways we can trade them. Crude oil, there's a signal, bullish signal. It saw we're breaking out of the triangle. Looks like we're coming back into the triangle, but anyway, we have a bullish signal with a take profit and a stop loss. And you can use these signals, of course, in your options trading as well, but not in crude. Let's say we go to euro dollar. We've got a signal, channel up, apply the pattern. And now let's look at an option instead of spot. Let's look at a 2-month option. So you can see on the screen what that chart looks like, and you can use that as a reference when you're setting your strikes. You might want to set your strike up here. You might want to use that channel to set your strike down here. You might want to buy a call that would be in the money. You might want to sell a call. This is basically saying the market is going to continue to move. Well, the signal actually saw us breaking out. The signal was down here. The signal was looking for a breakout to the downside. So if you believe that, you might want to sell a call. Can anybody hear me? Can you hear me? Nobody can hear me? I'm going to switch heads. Someone said that they couldn't hear me. Okay, now I hope you can hear me. Can anybody just type into the chat that you can hear me? Alan, Sajiv, Simon, Boris, Mike, Jamil, Ahmed, anybody? Okay, great. Thanks very much. You can hear me. Okay, what else can I tell you? Please type in your questions. Call spread. What's a call spread and why would I use a call spread? Here's a call spread. I'm going to get rid of these signals. Clean up the chart. It's over here. Channel up. This is a call spread. A call spread says I'm going to buy one call and sell another call. It's a very low risk trade because we're limiting our downside and we're limiting our upside. Why would we work this way? If I buy a call, let's say I buy a call at 97.50, it's going to cost me 365 pips for 2 months because it's already in the money. It's very expensive. Let's do one that's at the money. A par 1.000 call on Eurodollar for 2 months costs me 196 pips, almost 2 points. It's expensive because the market has been very volatile. A year ago, implied vol on Eurodollar was half of this. Look, implied volatility, let's look at Eurodollar. For a year. A year ago, implied volatility was at 5%. Now, central banks are in action. Interest rates are changing. They're changing differently in different countries. And therefore, volatility is moving higher. Makes sense. Markets are moving steadily, steadily, steadily. Implied vols have moved higher. If I buy this option, because of that, it's going to cost me almost 2 points. Let's see, back to the par call. It's going to cost me almost 2 points. It's expensive. So one thing I can do to reduce the cost is to sell some of that upside. If I do a call spread and I buy a call at 1 and I sell a call at 104, I can reduce my cost by 40 pips, 45 pips. So now it's only costing me 150 pips to buy this option. And maybe I'm happy with that because I don't really see us going higher than 104 in the next month. So I am giving up some upside here. I'm capping my upside, but I'm also reducing my costs. So I'm reducing my downside. So that's why you would use a call spread. Same thing for a put spread. You can get the same effect by selling a put spread. So another way to do it. It's exactly the same P&L, but the upfront cost you'll be receiving instead of paying premium. It doesn't really matter because everything gets to market. So if I buy this put and sell the in-the-money put, it's the same green and red, the same P&L diagram, but just a different way of trading. It doesn't impact our systems. Up at the top, I didn't show you, we have this, the equity section. I can just click it and it's down here on the right, on the bottom right. This is what your account looks like. My net liquidation value is $25,000. I have $29,000 of cash. To close all of my options would cost me $4,600. And I have unrealized spot P&L of $1,100, $1,200. So my net liquidation value, if I close all my positions, $25,800. My required margin is $9,800, which means I'm using 38% of my available line. And that's why you have this green bar under my equity. That green bar is 38% of the way across. If it gets above 70, that line will turn yellow to kind of warn you that you're approaching your margin limits. And if it gets to 100%, it'll turn red. And when it turns red, you will only be able to close trades. You won't be able to open new trades unless you make a deposit because you'll be using all of your available margin. If your account value drops below half of the required margin, we close all of your positions automatically to protect you from losing more than your account value. Any other questions? Definitely log in, play with this system, get a demo account if you don't have one. And here on the side menus, you can upload documents, you can make deposits and withdrawals. You have access to all of your positions, all of your accounts when you log in through the Ava website. We have chat. We have video tutorials. A lot of the video tutorials are using our mobile app, but you have a whole list a whole playlist of things you can look at, which include webinars. The mobile app looks just like the web trader. Okay, I'm going to end the webinar now, unless anyone has more questions, because I want to keep this thing under an hour, as I mentioned, or under 50 minutes. So thank you for joining. Get familiar with the platform. Don't trade until you're familiar with it, until you're comfortable. But this is a great platform, easy to use, getting great feedback from our customers. And again, the mobile app is the same. And because I didn't say it earlier, we don't give advice on what to trade or how to trade or directional trading. We give you the tools, do your research, decide what's your risk appetite, what your views of the market, and set up the trade. I just really like options because you have so much more control over your P&L. It's not simply buy or sell. You can buy and control your risk and say, how much am I willing to lose, and not using a stop loss, using options. What's my exposure? Do I believe the market is going to stay below a certain level? Great, sell a call option, get paid for that, earn some premium. Would you like to buy gold if it drops back to 1600? Great, sell a put option. So while you're waiting, you're earning premium. There are so many things that you can do with options. You have total flexibility and control of over your exposure. So thanks very much. See you next time.